Okay, so welcome back. We are on deck number 5, and we're going to talk today about CCPC investment income, which, as you'll recall from our rate discussion a couple weeks ago, gets taxed somewhat differently than either general rate business income or small business deduction eligible business income. So if we take a look at slide 2 of our deck, um, it's always useful to think about the policy problem that we're trying to avoid when we're dealing with rules like CCPC investment income. So the handouts talk about how one of the major drivers in the act is neutrality, which is this idea that whatever you're doing for commercial purposes should be taxed in substantially the same way, regardless of the form in which that activity is being carried on. So the idea being that identical things should be taxed identically, right? We're not perfect about neutrality. We talk a bunch about the small business deduction, which for reasons we've canvassed is kind of a neutrality fail, that it's not available to individuals, for example, who carry on business directly. But we're generally pretty good about neutrality in Canadian tax, at least most of the time. The other policy issue that comes into play with investment income is this idea that corporate income should be taxed only once, right? That we don't want to have multiple levels of tax on corporations at the corporate level. We just want to have corporate income taxed once while it's still within the world of corporations, and then taxed the second time when it's distributed as a dividend to the individual shareholders of the ultimate corporation. So what this means is that we have to implement this desire to tax dividends or to tax corporate income only once. And the way we do that is with a deduction for intercorporate dividends in subsection 112.1. We're going to take a closer look at subsection 112.1 later, so you don't need to think too hard about it right now, but just know that it's there. And we talked a few weeks ago about how there's a real upper limit on the general corporate income tax rate, and that as a result of international pressure, essentially just downward pressure created by our peer states, we have set our corporate tax rate at a much lower rate than our general personal income tax rate. And so this creates a potential neutrality problem, right? If we did not have a special regime for corporate investment income, and we just taxed corporate investment income at the general 23% rate, you would have rich people creating what we'd call incorporated pocketbooks, where they essentially transfer all their investment assets to a corporation and just earn their investment income through the corporation. So, for example, if you have somebody with a very large bond portfolio, and you didn't have a special regime for taxing CCPC investment income, well, that person would just stick the bond portfolio into a corporation. When interest payments are received, they'd pay tax at 23%. And that would be it, right? They're rich. They probably don't need the money. And so it would just sit at the corporate level, having paid tax at 23%. Meanwhile, somebody who isn't rich enough, they need to do that, and they need to own the bond portfolio personally so that they can receive the interest income personally and spend it in order to live. That person's going to pay tax at marginal rates up to 48%. So it would be a glaring failure of neutrality if we allowed people to just have their incorporated pocketbooks subject to tax at the general rate. And it would also allow for very rich people to have this deferral opportunity that other people don't get to have, right? It's so there's a vertical equity problem there as well. And the neutrality problem with dividends is essentially the same, right? So suppose our rich guy, instead of having a bond portfolio, suppose he has a portfolio of dividend paying securities. So again, if we didn't have a special regime for dealing with corporate dividend investment income, then what would happen is dude would just earn dividend income through his CCPC Blocker Corporation. Blocker Corporation gets a subsection 112(1) deduction, and that would be it. So the money would just sit in the CCPC without any tax having been paid, except at the dividend payer level, which our investor is probably not super sensitive to that underlying corporate tax. If we're talking about publicly traded securities, an individual investor probably doesn't care about the corporation's effective tax rate, except the extent that it plays into earnings per share and therefore plays into the share price on the exchange. So that's a potential concern, right? Again, this wouldn't happen if Rich Dude owned the share personally. Rich Dude would be subject to tax at a rate of somewhere between, in Alberta, 34% and 42.31% on that dividend income. So again, it's a huge deferral opportunity, and it's a real failure of neutrality if we allow that to happen. So if we flip to slide 3, we have this policy problem and we have a conceptual solution. And so the way we've solved this policy problem, at least in theory, is to cause CCPCs to be taxed on non-dividend investment income at a rate that would, in theory, be somewhat higher than the top marginal rate applicable to individuals. However, what we've done is we've made those additional taxes refundable when equivalent dividends are paid to the individual shareholders by the CCPC, with the idea that the shareholder can avoid being overtaxed on their investment income at a combined corporate shareholder rate by paying dividends equal to 80% of their pre-tax investment income in order to obtain a refund of the refundable taxes. So this is not a bad deal. In theory, the investor gets a integrated rate, which means that we've solved our neutrality problem, and as well that there's something of an incentive to pay dividends to the individual investor in the current taxation year to avoid being overtaxed. And so we've also solved our deferral issue as well. Again, this is in a theoretically perfect world, and as we're going to see, this is not how things quite work in practice. And the reason why things don't quite work in practice is that our non-eligible dividend tax credit rates and provincial income tax rates don't totally square with the assumptions about provincial and federal personal and corporate income tax rates that the federal Department of Finance made when they were drafting all of the provisions that are relevant to applying these rules. You'll see this for yourself a little bit today, and you're going to see it a lot more in our next unit, in Unit 6, which talks about corporate distributions, where these assumptions start to come into play. We talked about them a little bit in week 2, that our corporate tax system is, instead of tracking tax attributes all the way through the corporation, we make assumptions and we impose tax on the basis of assumptions, which makes life significantly easier. We do have a regime in the foreign affiliate context where people track, people have to track attributes, etc., all the way through to the beginning of time in order to figure out how a distribution from a foreign affiliate is supposed to be taxed. There are basically everybody in the country who understands how those rules work at a functional level could fit into a not super large conference room, at the Metro Toronto Convention Center or similar. Like there's probably a few hundred people at most. There's 1 or 2 lawyers in Edmonton, one of them being me, who practices in that in that area. So it's not a practical solution, right? To do that for 90% of the tax or 95% of the taxpayers in this country who carry on business through corporations. So we have to use assumptions. It's a much simpler system, but what we're going to see is that when the assumptions are wrong, you get some weird marginal incentives, and as we go through the course, you'll start to pick up where those marginal incentives might be. But in a theoretically perfect world, suppose a CCPC with a single shareholder earned interest income of $100, right? So in our current world, to use current rates, the corporation would have to pay tax, including the refundable taxes on that interest income of $46.67, so at an effective rate of 46 2/3%. But before it actually had to remit this refundable tax, the corporation would pay an $80 dividend to its individual shareholder. And by doing so, it would obtain a refund of $30.67, which is, again, this is our theoretically perfect world, 30 2/3% of the total tax imposed. And this would reduce the combined, this would reduce the corporate tax net of the refund to $16. The individual would then have tax payable on the $80 dividend. We'd probably, in a perfect world, want the tax to be payable at an effective rate of about 40% in this, on these assumptions, so that our combined personal and shareholder rate would work out to about 48%, which is the top marginal rate in Alberta. What we're going to see is that this isn't quite how it works. You get to about a $49.85 tax liability in Alberta, so about a 49.85% combined corporate shareholder rate once you've flowed everything through. So it's not quite perfect, but it's reasonably close. So, like I said, in a theoretically perfect world, this additional tax and refund system works beautifully. In practice, not quite. In most cases, it works well enough that we do have enough of an incentive for the shareholder to distribute all of the investment income annually as is earned, and not to just simply build up a balance of refundable taxes in the corporation and just wait until, who knows what, in order to cause a refund of those refundable taxes. And so in that theoretically perfect world, like I said, you've solved the problem, or you have neutrality and you have no deferral, because everyone will just immediately flow everything through in order to be taxed at the correct rate. And the rate at which they are taxed at the end of the day really is the top marginal rate for individuals. This is one of those things where in Alberta, like I said, it mostly works, right? That our 49.85% combined corporate shareholder rate after you've flowed your income through the system, close enough, right? It's close enough to the 48% rate that you're probably not going to allow refundable tax to build up in the corporation, because even though you're 1.85% ahead, if you defer, you have to remember that every dollar of reinvestment income is also subject to tax at 46 2/3%. And so you do have this potential problem where you might be better off to just eat the 1.85% penalty rather than to have the high tax on the reinvestment income and just this sort of bullet that is the additional 1.85% even on the reinvestment income hanging over you. One of our former lawyers had put together a spreadsheet that put a lot of effort into mathing out that problem. Where it does not work is in some of the larger provinces like BC and Ontario. In those provinces, you do have an incentive to just build up RDTOH, because the combined corporate personal rate is significantly higher than the corporate rate after you've added on the refundable taxes. Use Ontario for an example. Once you've flowed through your dividends to recover your refundable tax, and you've paid the personal tax at the top marginal rate in Ontario, you end up a little bit under integrated, and so you have taxed at about 56%, whereas you would be at 50 2/3% if you just left the money in the corporation and ate the refundable tax. And so in Ontario, that's a big enough delta that people do leave the money in the corporation and just eat the refundable tax. So that's where it doesn't work perfectly. But Alberta, close enough, right? It's certainly pre 2019 or so. It was it was pretty clearly better to flow everything out. But that has changed a little bit as the general corporate rate in Alberta has dropped. So moving on, we can flip to slide 4, and we can now start to talk about how we implement this refundable tax regime. One of the things I'm going to warn you about now is that you're going to see in the slides and in the handouts references to subsection 129.3 and the paragraphs contained therein. Subsection 129.3, for those of you who are following along with your acts, was actually repealed in a few years ago as part of our move to go to, would have been 2017, as part of our move to go to the eligible and non-eligible refundable dividend tax on hand streams in order to prevent what people are calling the corporate purifier mechanism. I have left the references to subsection 129.3 in the slides and in the notes simply because I'm actually at a loss for how to effectively teach how the regime works using the new rules. Like they make a lot more sense, the new rules. If you understood how the old RDTOH regime worked, it's really easy to understand how the new regime works. But I find it very hard to explain to people conceptually how the new regime works if they don't understand how the old regime works. So we're gonna learn how things used to be. And then you should be ready enough that when when we release you into the world at the end of the year to go actually practice, you should be able to get yourself up to speed on the new regime fairly quickly and understand exactly what we're trying to do. And we'll talk about where some of the differences are as we go through this, but just be aware that if you're following along in your acts, you are going to want to see that subsection 129.3 was repealed. So you are going to want to look at the prior legislation. And as well, if you don't have a version of the act where the old subsection 129.3 is still there in the notes, notwithstanding the repeal, the definition of non-eligible refundable dividend tax on hand in subsection 129.4 contains most of the elements of what was formerly in subsection 129.3. So with that caveat out of the way, the first place that we need to really start as we dig through our legislation is in subsection 129.4 and the definition of aggregate investment income. So aggregate investment income is basically the corporation's income from a source that is property, plus the excess of its taxable capital gains for the year over its allowable capital losses for the year, but not including any intercorporate dividend income. So intercorporate dividends, they get dealt with separately in our refundable tax regime, so they're not included in aggregate investment income. But any other form of income from property, including interest, rents, royalties, etc., those are all aggregate investment income, as are net capital gain, right? So for this purpose, we actually have a definition of income from property, and that's again in subsection 129.4. And what you will see in that definition is that it includes income from a specified investment business carried on in Canada. A specified investment business, again, that's a defined term in subsection 125.7. We talked about it a little bit before, but it means a corporation, a business carried out by a corporation, the principal purpose of which is to derive income from property, including, again, rents, royalties, interest, etc., but not including rents from the leasing of tangible personal property. I think on the assumption that leasing tangible personal property comes with generally its own set of business type risks. If the business employs 5 or fewer full-time employees, you have to have more than 5 full-time employees. Like we talked about, 5 full-time employees plus a part-time employee is kosher, but anything less than that is bad. So that's a specified investment business concept, right? So again, we talked about this before, that a good example of the specified investment business is a self-storage facility. So, just to think about that, because again, the self-storage facility, it may be a business as opposed to just a source of income that is property, but the purpose of the self-storage facility is to earn is to earn income in the form of rent for the storage unit. So therefore, it's a business. The principal purpose of which is to derive income from property, in this case, rent. And generally speaking, these storage facilities will employ will not. Well, I say we should phrase it in the negative. Will not employ more than 5 full-time employees in the conduct of that business, right? Like there's no need. All you really need is one person and a security camera that covers covers any place they can't see, right? That's all a storage business really needs. And so that would be a specified investment business. So a specified investment business is not great, right? It's kind of a kick in the junk for the people who own it, because not only do you not get the small business deduction, you also don't get the general rate reduction, as we're going to see, and you actually get included in aggregate investment income. And so as a result, you're into our anti-deferral regime, and that centers on the aggregate investment income concept. So this is like we've talked about when we were talking about corporate rates more generally, this is a massive swing in tax consequence for the corporation. Right? You go from, if you're a CCPC that would otherwise be small business deduction eligible, you go from tax at a combined federal Alberta rate at 11% to tax at a combined federal Alberta rate of 46 2/3%. So just, well, I cannot emphasize enough like how big a swing that is, and how annoyed people will be if they inadvertently find themselves in that position. So now that we understand what aggregate investment income is, we can start to see why it's important. And the first reason is that we use the aggregate investment income definition, like I said, to cause income to not be eligible for the general rate reduction, which helps us get our pre-refund corporate tax rate high. And so if we're looking at why it's denied, you can take a look at subparagraph B3 of the definition of full rate taxable income in subsection 123.4 sub 1, which specifically carves aggregate investment income out of full rate taxable income. And so because aggregate investment income is not full rate taxable income, then it is not income that is eligible for the general rate reduction under subsection 123.4(2). Right? So knowing that, we now know at this stage, with just the provisions we've talked about so far, that our aggregate investment income is taxed at a federal rate of 38%, right, which is our base rate, less the provincial abatement in subsection 124(1), which gets us down to 28%. Then you would add on the provincial rate, which is 8% in Alberta. So that brings us to 36% based on just what we've seen so far, which is, not a low rate, right, by any OECD standard, but it's not high enough relative to where our personal income tax rates in Canada are. So we need something more to make this regime work. And if we flip to slide 5, we can see what that something more is. And again, if you've done your readings, you'll see that everything on the slide is simplified, in some cases a little bit, in some cases substantially, but what you're seeing on the slide is good enough for this course, and in real life is good enough for about 99% of practitioners. So close enough, right? So do read the provisions and make sure that you understand how things could get interesting when you have foreign source property income or foreign source business income. But again, we're dealing in close enough here. So the provision that we care about to get our rate all the way up to where we want it to be is section 123.3. And what section 123.3 does is it provides for an additional tax equal to 10 2/3% of the lesser of the corporation's aggregate investment income, or the 3 amounts set out in subsection 125.1. So when you think about what's in subsection 125.1, what that really means is basically that the corporation is going to be subject to tax at 10 2/3% of the lesser of the corporation's aggregate investment income, or the corporation's taxable income after you've made some adjustments for loss carry forwards and foreign tax credits, etc. So on the exam, and I think in the rest of this course, for the most part, I think we're always going to think of section 123.3 as being equal to 10 2/3% of the corporation's aggregate investment income. I don't think we're ever going to look at paragraph 125.1b again in this context. So once we apply this additional tax on aggregate investment income, then that takes our combined federal Alberta rate from 36% to 46 2/3%, which is exactly where we want to be, right? I mean, it's in a theoretically perfect world, we'd probably be a little bit higher, again, because as we're going to, as you may have guessed, the federal assumption is that Alberta would impose corporate tax at a 10% rate. So in a theoretically perfect world, our pre-refund rate would actually be 48 2/3% rather than 46 2/3%. But again, we live in the real world, and it's 46 2/3%. So with that out of the way, having now got our corporate tax rate all the way up to 46 2/3%, we can now start to look at the provisions that get our refund. So that get our post-refund rate down to about 18%, or in fact even lower than that now in Alberta, get us all the way down to 16% as of this year. So where that happens is this concept of refundable dividend tax on hand, or RDTOH, which is a notional account. It's not actually on hand. It's just called on hand, sort of like how we call things an accrual when they're not accruals and whatever. It's a purely notional account. Like you see on the slide, the old RDTOH definition was in subsection 129.3. As I've mentioned, the new definition of non-eligible refundable dividend tax on hand in subsection 129.4 incorporates most of the former definition in subsection 129.3. But anyway, so in pretend land, where the old definition was never repealed, subsection 129.3 defines RDTOH as an amount that's computed at the end of the CCPC's taxation year. And it's so, I mean, that's important. It's not a point in time test. It's something where you have to effectively have closed the books on the year to know for certain what the corporation's refundable dividend tax on hand will be. For our purposes, if the corporation is a CCPC, then refundable dividend tax on hand would be equal to 30 2/3%, so 30.67 of the corporation's aggregate investment income, and it's tax payable for the year. So the lesser of those two amounts, which in this course, I think it's always going to be 30 2/3% or 30.67%, however you want to express that, plus the Part 4 tax payable by the corporation in the year on dividends received by the corporation. If the corporation is a non-CCPC, then its RDTOH balance is simply going to be equal to the Part 4 tax payable by the corporation when it received dividends from other corporations, and we're going to talk about Part 4 tax in a little bit, plus the non-refunded refundable dividend tax on hand for the prior taxation year. And so that's true for CCPCs as well. So if you don't cause a refund of RDTOH, it just gets carried over and it just builds over time, right? Both for CCPCs and for non-CCPCs. Then if we flip to slide 6, we have this concept of the dividend refund and subsection 129 sub 1, which is the last piece of our puzzle. And what subsection 129.1 does is it provides for a refund of refundable tax on hand when taxable dividends are paid to shareholders. So the threshold requirement for a dividend refund under subsection 129.1 is that the corporation claiming the dividend refund must have filed its return for the year in which the dividend refund is claimed, not for the year in which the RDTOH was generated, which is an important point, but for the year in which the dividend refund was claimed within 3 years of the due date within 3 years of the last day of the taxation year. So provided that requirement is met, then the dividend refund may be paid by the CRA. And you would think that filing your return within 3 years is not a super hardship, but you would be wrong. There's actually a series of cases, including Presidential MSH Corp and Tawa Developments, which Tawa is I think the only case where I am on as counsel. I'm Pyrrhus co-counsel on that one. So the only tax case where people just flat out failed to file their returns. And the question is, what would happen with the RDTOH where you didn't file the returns and therefore weren't eligible for the dividend refund? Like, did the RDTOH disappear into the air so that you just never got properly integrated? And the courts came to the conclusion that no, the RDTOH doesn't disappear. If you don't actually claim the dividend refund or aren't eligible for the dividend refund because you didn't file your returns, the RDTOH just carries forward indefinitely, and you can eventually recover it by paying another dividend in a taxation year in which you actually can be bothered to file a return. So interesting, but so an important point, right, for some less diligent taxpayers, that you do actually have to file your returns in order to get a dividend refund. So the dividend refund, once we've got past that, the return filing threshold, which is applicable to idiots primarily, then you can move to the more technical requirements. And so the dividend refund is equal to 38 1/3% of all taxable dividends paid by the corporation in the year, to a maximum of the corporation's RDTOH balance at the end of the year. In other words, it's a refund of $1 for every $2.61 of taxable dividends paid, to a maximum of the 30 2/3% refundable tax that was payable in the year or paid in a prior year and not refunded. So for those of you who are trying to do the math in your head or have already done the math at home, you'll see how this ties together reasonably well with our $100 of interest income example. So 30.67 multiplied by 2.61 is basically 80. I mean, I think it's not exactly 80, but it's so substantially close to 80 that you don't care. So by paying out $80 of income as a taxable dividend, which would be our amount net of the non-refundable corporate taxes, again, making some assumptions about what the federal and provincial corporate tax rates would be, then the corporation should be entitled to a dividend refund under subsection 129(1) of $30.67, which would cause the corporate tax payable in a theoretically perfect world to drop to basically drop the corporate tax to $20, which is the net after that $80 net cash is remaining in the corporation after the $80 dividend was paid. In reality, it actually drops us from 46 2/3% down to $16 or 16% effective non-refundable corporate tax. But again, close enough to the theoretically perfect world. So then we can move to slide 7, and we have some questions in slide 7 that we can start to work our way through. And some of these are relatively straightforward if you're looking at the legislation, so I can throw them out to you. So question 1, what corporations are eligible for a dividend refund? Jacob.
Isn't it any private corporation?
That's correct. Yeah. So to get a dividend refund, you have to be a private corporation. And so this can be a potential issue, right? That if a corporation loses its status as a private corporation, it's no longer entitled to a dividend refund after the point where it ceases to be a private corporation. And so this can become an important planning point if you're acting for a corporation that, for example, might be having an IPO or that might be being acquired by another corporation that is not itself a private corporation. Is that you will want to make sure that if you have a giant pile of refundable dividend tax on hand, whether it's eligible or non-eligible, that you probably should take some action in order to obtain that refund, right? In order so that, because otherwise, as soon as you lose private corporation status, you lose the ability to generate the refund. Interestingly enough, I don't think it necessarily follows that you lose the RDTOH balance. I think that you might still be able to track your RDTOH. You don't add to it anymore, obviously, unless you're a specified corporation or a subject. We'll talk about that later. But by and large, you don't add to it anymore. But you lose the ability to get it back. So pretty important if you're going to lose private corporation status, recover your refundable taxes before you do. Okay, next. Our next question is, why is subsection 129 limited in the way it is? So why is the dividend refund limited to 38 1/3% of taxable dividends paid and or its refundable dividend tax on hand? Okay, so to ruin the suspense here, right? The reason why we limit the dividend refund under subsection 129(1) to either 30 to our basically $2.61 of dividend to 2.61 of dividends paid, or to the RDTOH balance that the corporation has available, is that if we allowed a larger dividend refund, then what we would be doing is we'd be under-integrate or under-taxing corporate investment income, because we would now be refunding what should be the non-refundable portion of the corporate tax. And so if you start refunding that, you're going to effectively end up under-taxing, because you're going to have less corporate tax than we assume when we're setting the tax rates for either eligible or non-eligible dividends. So that's the reason why, again, this is where, by limiting it to RDTOH, is interesting, because this is the case where we're both tracking an attribute and basing our tax system on assumptions. So we're kind of doing two things, both things at once. But yeah, that's the rationale. So question 3, or I guess question 6C is, what does RDTOH represent? Okay, again, so to ruin the suspense, RDTOH in its pre-repeal form, and generally non-eligible refundable dividend tax on hand in its post-repeal form, basically represents the corporation's tax payable in excess of the non-refundable portion of the corporate tax, which in a theoretically perfect world would be about 20%. So it's a tax paid on the investment income, including the additional 10 2/3% tax under section 123.3, in excess of that target non-refund rate. So in our real world, it's the tax in excess of 16%. And as well, it's including the Part 4 tax that's been paid by the corporation. And so we're going to talk about Part 4 tax, I believe, later today. So we'll see how that works. And then our next question is what kind of income earned and distributed as a taxable dividend generates a dividend refund? So again, what we're going to see is that passive income is the kind of income that, when distributed by a corporation to its shareholders as a taxable dividend, generates a dividend refund. Indirectly, what we're going to see as well is that some types of dividend income, when received by a corporation, will be subject to what we call Part 4 tax, which gets included in eligible RDTOH or non-eligible RDTOH in current world, or just regular old RDTOH in the pre-repeal world. And that will also get refunded to the corporation when it pays corresponding dividends to its shareholders. So then we can go to slide 8, and slide 8 deals with question 7, and this is in handout number 11, and we're on page 2 of the handout. And so in question 7, we have EXCO, which is a CCPC, earns $1,000 of interest income. And so we're asking, what are the tax consequences to EXCO when it pays a taxable dividend of $800 in the taxation year? And so again, to do this problem, when EXCO earns the $1,000 of interest income, it becomes liable for tax of 46 2/3%, which would be $466.70 in this example. And this is by virtue of the combined interaction of subsections 123.1, 124.1, 123.4 sub 1, and section 123.3. And the sum of $306.70, which is 30 2/3%, will be added to its RDTOH account at the end of the year under subsection 129 sub 3. Or in current world, it gets added to the non-eligible RDTOH account as defined in subsection 129 sub 4, again at the end of the taxation year. So then, when EXCO pays a taxable dividend of $800, it becomes entitled to a dividend refund equal to the lesser of 38 1/3% of this amount, which is $306.70, or 30 2/3%, under subsection 129 sub 1. So EXCO will remain liable for corporate tax of $160 on the interest income, of which 8% is going to be federal tax and 8% is going to be Alberta tax. The shareholder of EXCO is going to become liable for tax on an $800 dividend. And we're going to see as we go through how that $800 dividend gets taxed. That's going to be in topic number 6. We're going to look at that. But just know there's going to be tax on the $800 dividend that was received in order to generate the refund. And what we're going to see as well is that if you've been following very closely at home, is that we actually have a bit of a spread here, right? Where this spread of 16% tax non-refundable versus the theoretical 20% rate that we're assuming in setting the dividend refund where we have, is that there's actually $40 of tax after-tax cash remaining in the corporation that hasn't been distributed. So that isn't going to be used to pay the non-refundable corporate tax of $160, and that isn't being distributed as part of the $800 dividend. That $40 is just going to sit there, and the corporation could distribute it as a dividend later, or they might not. Who knows? So with that, I guess first of all, do we have questions at this point? Anybody? Okay, seeing none, why don't we take a break? I think because otherwise, if we start on the next problem, we're probably going to be going a little bit longer than we'd like. So let's do that. I'm going to stop recording, and we can come back at 2 o'clock.
Professor?